Welcome into the live stream today. We're going to be breaking down the Fed and, of course, the FOMC meeting that is about to happen. And all of this is going to pertain to where crypto is going. Before we get started, I want to thank our sponsor. That, of course, is Tangem. You guys can jump over to tangem.com, get your self-custody started with them. It's very easy to set up. I would say this is probably out of all the wallets I've checked and tried and tested, I would say this is still my leading candidate for best and easiest to use. Of course, you guys can, of course, use the link down below, get a little bit more of a discount. It does grab not only the current discount they have, but also our discount. So use that. Very fast to set up and super secure to get started. Listen, there's going to be a lot said today from Chair Powell. And I think when you think at all of the potential things that could be said, remember, the forward-looking statements are the key going into what the chair is going to do possibly, or I should say the Fed is going to do for the next rate cut that potential would happen in late January, because this is the thing that everybody's looking to right now. If you look at Polymarket, these are all the potential statements that Powell could say. I'll zoom in on that for you guys. Inflation, 40 plus times right now. 80%, do you think he'll say it that many times? That's a lot. 50 plus time, about 50. You can kind of see employment, unemployment. We'll be talking about jobs because that is a big issue right now. And of course, interesting, AI. He'll mention this 3 times. That's a 56%. The one though that I don't like as we start to look at further in the scenario is this one right here, shutdown. 88% right now. So pretty huge. Bitcoin right now and crypto setting at 12%. This is a big deal. Of course, this is happening when he goes back out to the press corps. He does the analysis. This is the live press. Just to let everybody know, it is a quarter basis point rate cut that is in, as has been anticipated. But remember, this wasn't an easy win. A lot of this only happened in really the last 3 weeks when Polymarket was very undecided on this. We started seeing some of the job numbers come out, even though we're getting lagging data. But some of the job data that we are getting is pretty horrific for the U.S. job market. And I think this has been the big factor that, of course, Chair Powell is dealing with. Of course, this is the situation that they were facing, and that was that it is still a split decision, or was a split decision, but pairing a rate cut around future moves is really going to depend on this data. Now, here's my question. Where is this data going to be coming from? Because the BLS has already talked about they're going to either slow down the data we'll have from October to after today. So if in fact that the chair or the Fed was actually using data, I'm not sure what they're going to be looking at going forward. Now, it's possible they could be looking at what we're seeing in terms of CPI data around inflation. Obviously, the market has started to respond to this, but I think the greater thing that we have to consider is how the global market is really playing into this. One point just to kind of go in, I just want to hit on we've got the quarter basis point right there confirmed by Guru. And I think this is the scenario. Now we're looking at one thing, and that is January, because this will start to line up very interestingly around whether or not we'll get a rate cut on the end of January. And if we do, that would be consecutive rate cuts really back to back for almost 3 times. And if you look at where we have been in terms of rate cuts over the short time, which a lot of people still think we are lagging in that. Many people still want more than that. And I think the real question is whether or not we see the comparison that this is going to hit in terms of the market. Now, the decision today, as you can kind of see, here's the contrarian take from Tom Lee and Fundstrat. Markets have been laboring and struggling past 4 weeks, I would agree. Nobody wants to be long on stocks in front of a hawkish cut, and that's the question we'll find out here in a minute when we go live with Chair Powell to address the press. To me, it seems to raise probabilities that stocks rally post-decision. It's because we have seen a little bit of a lagging, and I'll show you some examples of this here in a second. We've got a few clips on this to kind of get into it, but get the premium first word, I think obviously is head of the street. If you guys aren't subscribe to what Tom Lee is doing over there. I do get his email and his newsletter. He does a pretty good job on keeping you updated of what's happening. One thing I do want to go to is a clip, because this is CNBC talking about the potential of a pullback, though, in 2026. Take a look.
Because you are a bit out of consensus here with what you expect for stocks next year, how much of this does hinge on what we are seeing right now in the bond market and as we do await a Fed decision?
A lot of it, Morgan. And part of it is because my target for the 10-year is around 445. And the reason I say that is I think we're going to move away a little bit from being concerned about inflation at the Fed level, and that will cause inflationary expectations to rise. At the same time, there's a lot of tricky precedents that happen in the mid-year election cycle. The last two of them have been actually the last two bear markets we've had in 15 years. We're in 2022 and 2018. Also, there's this uncanny coincidence that a new Fed chair tends to get a test early in his or her term. And so we have this confluence of the tricky second-year presidential cycle coinciding with a new Fed chair and one who is probably going to pay less attention to inflationary expectations at the expense of lower short-term rates, as Rick was alluding to. That's all getting priced in, and that's where I see a little bit of a possibility of a pullback. And just part of it is I'm a natural contrarian.
All right, a natural contrarian. I don't know. Maybe I am more of a natural bull in the sense that I agree that Tom Lee might be onto something here. I'm still concerned that we could see some outlying data, but also some outlying conditions on the global macro side of things. But overall, I'm feeling pretty good about the fact that the Fed is starting to slow the market down in the sense that these rate cuts could come in and what that might look like going forward. I think the key here, though, is really built around a couple of things. One, of course, is how does the Mag 7 do? How does the S&P 500 do? Because that usually is the leader into what's happening with the crypto market. Now, here's the thing that Lee was kind of referencing right here is that 5 out of 7 stocks of the Mix 7 are actually underperforming this year. So 500 of the S&P 500, 5 of the 7 are not getting in, and that's Amazon, Apple, Tesla, we know, Meta, and Microsoft, which is a bit of a surprise there. But if you look at NVIDIA, which is up 35%, Google, of course, hitting it out of the park at 70%. When you guys are going into the market right now, for those of you watching the channel, because I know there's a lot of new viewers and listeners over in the audio podcast, are you betting more right now on the S&P 500 and gold or something like that? Or are you sticking your portfolio primarily into crypto as a whole? Let me know in the comments down below. I don't know if we're going to get a chance to take any questions today, but we will get into some if we can. We will be heading over to watch Chair Powell here in a second. We'll get a full ramp of what his, if this is a bullish, or I should say hawkish cut going into this next cycle, all of it could really start to play out for the point of where crypto could get a little bit of liquidity moving into it. And of course, things are still brewing around what's going to happen with Japan, how this is going to play into the reverse carry. How is this going to play into even yield instruments that we'll see across a variety of different tools, including stablecoins, for sure. Here's what people are saying, though, what will happen to crypto post-FOMC. Right now, it's holding on rally, but barely at 37%. So if you guys look at the market, let's go over and just check the ETH chart. This is on the 1 minute right now. So, you know, I'll probably run that down to the 5 minute. But when you look at the 1 minute, let's run to the 5 minute. That'll give us a little bit more of an indicator. But you can kind of see a little bit over the past half hour there. Let's take a look at Bitcoin. Right now, responding nicely, 92.6, trying to regain what has been around that 93,000 mark over the last little bit. So of the two, if you look at Bitcoin versus ETH, that's another situation that, you know, is a little bit different because ETH has been outperforming Bitcoin, at least in the short term. And I still believe this is really still the play for 2026. Other things that are going on out there that I think are important is this right here, is that remember when you look at the previous FOMC meetings, the last 4, Bitcoin dumped, all right? And one of them, the last one, resulted in a 30% dump. So that was when Powell was getting a little bit more hawkish. In fact, the last time we heard from him, remember that the probability of a rate cut plummeted dramatically. So what really shifted for Powell and his team of cronies over there at the Fed to pivot and go into another quarter basis point into the year end? What really shifted? I mean, is it pressure from the administration? Is it a situation that we're seeing right now from the market in terms of the economy? All of that maybe is playing into it, of course, because he's flying blind in reality with very little data going forward. Ted also hit right here, crypto is very quiet right now because most big players have shifted their focus to equities. That's my question to you guys. Have you done this? Have you shifted out to equities? Because this is something that I think I've started to talk to more people, and so even some of our own traders that are out there right now in the market, and they are a lot more conservative right now. So maybe they're looking for a market reposition, or does this get into kind of a bull market, or a bear market rally where this could go into maybe the first quarter of next year, especially if we get a January rate cut. But right now, risk reward is better at the moment. Market is more liquid. That will change once the Bitcoin chart starts catching up a little bit. I still see a little bit more of asymmetric upside in altcoins. I would agree with that. I feel like ETH and a handful of others are definitely outperforming. And I think that question is how far will they outperform in the coming months and weeks? So how will the year end for the crypto market? We rallied closer to new highs. Wow, 48%. So you guys are really expecting a Santa rally on this. I'm not in that camp, guys. I'm more in the camp of really seeing how the year ends and starts up with next year, because the concern I have is still the economy, it's still jobs, and that in itself creates a little bit of pressure on liquidity, even though the S&P 500 reacts a completely different way. But the other factor is that institutional capital, I won't say goes dormant, but for the most part can go dormant during these late weeks in the year unless we get a big retail surge going forward. So that's the question for sure. We're going to drop some more polls out there for you guys as well. But right now, retail investors are beating the market. That's right. Retail investors who invested through ETFs have now returned already 23% year to date on average. Imagine you are a retail investor. You've never invested in crypto. You drop into an ETF for the first time and you return 23%. Think about that for a second, because most of these people are looking at 23% over multiple years. This is not a typical investor. It's why we've seen so much activity with the ETFs, whether it has been the Bitcoin ETFs, the Ethereum ETFs, the Solana ETF, the XRP ETF. All of these have really started to fly and get going. Even Brad Carlinghouse was tweeting about this on the XRP ETF cracking over $1 billion in just, 18 days or so? That's huge. If you look at this in comparison, dollar cost averaging measures performance, same fixed amount invested. If you guys aren't DCAing through a lot of your strategies, because I think most people are in it now for the long term. They understand these cycles do appear. Even though I had Lynn Alden on the show just this week, and Lynn's take was very simple, is that the 4-year cycle is over. And if that is the case, we are going to see a different way in which the market responds. However, Lynn also kind of hit on the point that Powell may pause a little bit before we start to see a really acceleration with a new chair that possibly could come into the position in May. I'm a little bit on the other side. I feel like this may be an accelerated rate cut season going into May, and then obviously when we get the announcement of the new chair, that of course changes everything in general. We will be going live. By the way, if you guys are not subscribed to the channel, I'm going to ask you to do that right now. Just take a moment, hit subscribe. And remember, if you like these lives, then you want to hit that little bell, because it's going to give you a notification. You probably got one of these in your YouTube app. Hopefully it worked for you. I've heard some of the guys saying they're not getting notified, but make sure and hit the bell. It's going to give you notifications when we do go live. All right, a lot of good questions coming in. I understand. We will do it for sure. We'll get to some of those. Fed is, of course, poised to cut, which has happened, but long bonds keep selling off as the global easing cycle has ended. Traders are now pricing out more rate cuts from the ECB. I do agree with that. This, of course, from Abramowitz over at Bloomberg. And interesting point here is right here. And this is pricing in a rate hike this month in Japan and 2 quarter point increases next year in Australia. So you look at where Asia is, you look at the potential pressure on treasuries, you look at what's happening here now with the Fed, which is a quarter point off right now in December. Do we get another quarter in January and really start to see a reverse carry trade unwind completely? That would be a little bit more bullish, I think, in terms of risk markets going forward. I want to go to another clip because if you get in the economy, this is the thing that concerns me, is how do you play the economy if jobs are still the pressure, but inflation is still a problem? Here is Jay Clayton talking about that. Take a look.
What we want to do is get the rate of increase below where the Fed thinks it needs to, to raise rates or not cut rates, because it's about 3% right now, which is about where it was when Biden left office, up a little bit. But the affordability issue is from the 22% increase in prices and inflation under Biden. There's just full stop right there. That's the affordability issue. And he ought to be able to explain that better.
Right. That's right. And look, I think that with the economic team, President Trump and the economic team led by Scott Bessent, you have people who very much understand this. And it was they were thrown, what I would say, the worst economy for the average American in my adult lifetime, in terms of like you said, the incredible increase in prices at the household.
Yeah, except for that, it's part of the reason that they won. And now Americans say, fix it, make it better.
All right, so the point they're getting at is they're blaming it on the Biden administration. Many of you would say, well, I don't know. We are now a year in. You would think that this economy would have been able to get it turned around, especially with all the winning that we have done, whether you believe that we're getting new jobs here in the U.S. or not. The idea is that the inflation is not slowed. It has not slowed down. And in fact, affordability is a big problem. I think this is going to be one of the things that the Trump administration and the Republicans are going to have to deal with, without a doubt, going into these midterms if they don't get things corrected fairly quickly. And of course, I know that many people would say, all right, no, it's the Fed. If we continue to see an acceleration on rate cuts, this will fix everything. People will start hiring again. People will, of course, start putting more pressure or less pressure on price, and we'll start to see an economy readjust. I just don't know if that is going to be the case. I'm still a little bit more on the contrarian side of that, is that I think the Fed is going to get pressed because I think we're going to continue to see a problem with the economy going forward. Now, the question is Trump actually gaslighting the American people on affordability. Take a look at this clip.
It's one thing for the president to try to gaslight the American people about the immigrants that they're deporting, who are almost all nonviolent, non-criminals, or some bogus accusation about the Department of Justice or whatever. But you can't lie to people about their pocketbooks. People are feeling it every week, every month. They have to make ends meet. And this president is making it so much more difficult for the vast majority of Americans to do that. So he can try to gaslight them by calling it a hoax, calling it a con job, but it's the money is coming out of their own wallets. So I don't know how he's going to do that. And the reality is that this economy is going in the wrong direction, and that the president has betrayed so many of his campaign promises.
All right, so I would disagree with this guy in the sense that he hasn't betrayed the promises. He's trying to get to them. The question is there so much down pressure from the previous administration, he's not going to be able to meet those promises? That's more likely going to be the case. Now, is Trump out there trying to manifest? Because you hear him all the time. He's over there saying, yes, we have the greatest A++ economy. I get that. Sometimes I will manifest or try to. That's a real thing. And if that is the case, he's going to need a lot of help. He's going to need a lot of help from the global macro side of things, which may be coming through the route of the Japanese, especially if we see them continuing to raise rates. So it is an issue right now. But if you look at the affordability in terms of where costs are, this is what the economists are talking about. Cost of living up 60%, healthcare up 38%, immigration 20%. You look at democracy. These are the things that matter the most in terms of whether or not they're going to continue to vote for a Republican or possibly, in some cases, even Democrats, based on what we're seeing right now. So right now it's cost of living and healthcare. Those are the two things by far most important in terms of how people are going to vote. I want to go to another clip here. This clip is talking about the Fed chair, because this is probably going to be the most important position in the Trump cabinet this cycle. And in terms, I'm talking about where we're going into a market position right now. Let me go to this clip.
Sweepstakes apparently not a done deal just yet, Becky. The president confirming last night on Air Force One that he and Treasury Secretary Scott Bessent will begin a series of interviews today with candidates to replace Fed Chair Jay Powell. The interviews will begin with former Fed Governor Kevin Warsh, according to two sources. They come despite comments from the president last week that he knew he was going to pick, and he said it again this time, along with overwhelming pricing in betting markets that is going to be NEC Director Kevin Hassett. Those odds are off just a little bit this morning. Hassett among those to be interviewed for the job. With the others, presumably, we're not sure. We think it's going to be Waller and maybe Reeder and or maybe Bowman. Apparently, it's just 4 of the 5 is what we understand. The interviews come after the choice of Hassett received some criticism out there, including from some leading bond investors. The CNBC Fed survey finding that 84% of respondents thought the president would choose Hassett, but only 11% believe the president should choose him. Among respondents, Waller was the favorite, followed by Warsh. Warsh, reached by CNBC, declined to comment. The Fed survey found concern that Hassett would be more dovish than Powell, quicker to cut rates amid job market weakness, and slower to raise them amid an inflation threat, along with concern about him being less independent.
All right, so you can kind of see this is a mixed audience right now on the Fed chair. You know, Hassett is not a slam dunk out of this administration. I think government will be in a position right now, especially if you think about what Trump is probably doing, which is consulting a lot with Bessent in terms of who is going to be the best to choose for this, because this is the critical position, as I said, going into next year, especially if we see a Fed chair that really gets more aggressive on rate cuts and aligns it with trying to get the economy back into a position here. As you guys saw, we are going to be going live with Chair Powell here in a few moments. The way it works, if you've never been to one of our live streams, is we air the press conference. Now, the press conference does one thing. It's going to answer the forward-looking guidance. And this is probably the most important thing. This is a good example. Markets fear the guidance, not the rate cut. This is something you have to think about as you start playing out. And whether you're betting short-term, long-term, or maybe you guys are even looking at swing trades, things of that nature around the market, it could get volatile based on what Powell says going into this conference right now that's going to happen here in about 7-8 minutes. He'll come on and he'll start taking questions. Now, typically what I try to do is I'll air that, I'll bring up charts in alignment with what he's talking about. You'll see sometimes real-time reaction from both Bitcoin and Ethereum, XRP, all those will have a little bit of a reaction. But my anticipation is I don't know that he is going to be as hawkish as people may think. And here's my only reason for this, is the economy pressure right now, which correlates to jobs. And this is one of the mandates, that is one of the most important mandates of the Fed, is to make sure that employment stays intact. And we are not in that position. Now, I've heard analysts talk about this all week, is that there's been this rotational side of things of where we've had a rolling recession. The idea is that certain sectors got hit then it rolled to a next sector and then maybe to the next sector. I'm kind of in agreement with that. The real question is the major sectors that got hit the most. Retail, restaurants, those are the ones that indicate the most pain in terms of Americans. And of course, it also contributes to the most gain when it comes to the economy, because that's where pricing is usually hit on, especially on food and energy. That, of course, is the other side of things on the inflation side. So Powell is in a very, very bad position right now. And of course, it showed with him kind of running into a quarter basis point after I still believe he was not planning on doing a cut in December on the last one. That's how bearish he was coming in, hawkish he was coming into this meeting. And I think we may see a reprint of that come January 28th, which will be the next rate cut potential here. ETH is the one to watch, I would say, and I do agree with this. I do think we'll see a test of maybe 100K. I would assume we'll go significantly higher. It's possible I do think that we will see another 100K in the short term for Bitcoin. I don't know if we'll see an all-time, at least early. I think the question is how does ETH respond? Does it get a wing underneath it and really start to take off? And if it does, then you know what that means. We're going to start to see a variety of key altcoins start to move. I am not in the camp that we are going to see everything up when ETH moves this time, mainly because the institutional capital that can be supported under ETH and some of these big ones like Solana and XRP, these ETFs I think are going to be very important in the first quarter of next year. I've got one more clip to play before we go into the meeting with Chair Powell. And this is Tom Lee, and he's talking about how do you price ETH right now. Take a look.
Ways to price Ethereum in their head. Okay. One is, what is its price ratio to Bitcoin? That should make sense because they're like, if you think Ethereum's story is getting better than Bitcoin, like there's more excitement or things happening, then its price ratio relative to Bitcoin should go up. If someone thinks Bitcoin gets to 200,000, which I think it will, then Ethereum, just to get to its long-term average, is like 16,000.
Yeah.
Okay, and it's like 3,000 right now. Now, if Ethereum gets to the same value as Bitcoin, the network value, that's like 250,000. Which, could Ethereum be more valuable than Bitcoin in the future? Keep in mind, OpenAI is probably, if it was a publicly traded company, would be worth $1 trillion. And it's one of 4 or 5 LLMs. OpenAI just by itself is worth 3 times Ethereum right now. Is Ethereum more valuable in relative to AI? Right, OpenAI is just one of like 8 models. And if Ethereum is the dominant L1, shouldn't that be worth
more than
a couple trillion?
All right, so dominant L1, I get that. You compare this to what's going on in the AI space. I still believe that the AI space is actually not completely vetted out yet in the sense of growth. I think we are going to go much further, much faster. There's a chart out there I invite you guys to go look at. It is the one where we were spending on World War I. And the amount of spending that we were doing on World War I in comparison to where we are right now in spending for AI. And remember, AI is in a position where it is going to change society in so many different ways. When we're spending it on a war, it's typically in the defense sector. So that's the one thing that I think Tom Lee is right about. Now, what he's getting at is this whole assumption of fair value for Bitcoin. And it really boils down to this right here, and that is this 200K mark. If the ratio recovers to the 8-year average, which is what he's implying that it would do, this would hit a $12,000 ETH. Now, that's his claim, and everybody's I know out there going, there's no way ETH is going to go to that. But if we see a 200K Bitcoin, there is a possibility. If the ratio recovers to the 2021 high, then that implies that the correlation would hit around a 22K ETH. Let me know what you guys think. Are you believing what Tom Lee has been preaching lately? If you are, let me know in the comments. I'm kind of curious because our research team is back and forth on whether or not he's accurate and whether or not some of his context timing is just off, because I think a lot of people are looking at it that way. We're going to be going live here in a few minutes with Chair Powell and the press corps to get into this. Let's take a look at the charts real quickly. Bitcoin, of course, right now I'm on the 5 minutes, so over the past 15, a little bit down, back down to 92.4. Let's take a look at Ethereum, holding in that right now at around 33.70. So a little bit sideways here, at least right now. Solana starting to also kind of mirror the same situation. XRP also, pretty much most of the majors kind of mirroring the same situation right now, waiting for what's going to happen in the next few minutes in this room right here, which of course is going to be Chair Powell hitting on the whole issue of whether or not this is a hawkish Fed cut or if they have a new outlook. Because if he goes back and says, wait, remember I was kind of hawkish on the previous one? Maybe I'll change my mind again. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. there is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a 1/4 percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just First, turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending is held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the two official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our two goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get three questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, then we try to take a balanced approach to to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means.
All right, so as you can see, this is a different Fed meeting for sure. Many people thought this was going to be a hawkish cut. This, I think, changes the markets quite a bit in terms of how things go. And we just did the poll. I don't know if we still have that up there, guys, for some of you. But it was about 80%, holding at 36% on dovish, neutral at 44%. Hawkish, very, very slow on the poll out there with over 1,000 votes in. And I think when you look at where the market is right now, Bitcoin holding now over 94K as we start to end the Fed meeting. ETH, of course, approaching what could be 3,500, maybe by end of day. We'll see if it plays out that way. But I'm looking at it this way. There was a couple of tweets that happened during the event there with Chair Powell that came over from Lynn Alden that I thought were interesting. And one is this right here. And this is, to me, kind of tells the tape. Powell suggests 20 to 25 billion on the monthly balance sheet expansion. This is the new baseline for ample reserves. Remember, the Fed works off of a reserve system where they need to inject capital in there just to maintain it, right? But they're doing 40 billion currently to deal with liquidity issues and to get ahead of April. So if that's happening now, and remember what he said in the meeting right there is that we're going to do this now, and we're probably going to follow this up. We will follow this up in the coming months. So if they continue at that rate, we are in, whether you want to call it a soft QE or whether you want to call it a gradual QE, they are in a print mode. This is above the 25 billion monthly balance sheet expansion that is needed. That in itself is pure quantitative easing. Now, does this mean that we're going to see a market explode out of this? I think people will be very interested in how this goes into the January cut potential. I want to go back over to Polymarket. I want to see if I've got the Polymarket up and just see what happened with this. Let's go to the Fed rate cut. Fed, here we go, decision in January. So let's zoom out on that right now. So right now we are setting still up on this, but maybe because of this, I anticipate this is going to reverse. My anticipation right now, depending on how this printing occurs and also the job numbers, because they're still concerned about the job, and they should be still concerned about the job numbers. Let me zoom in on that for you guys so you can see. This, of course, is happening right now as Polymarket spiked right there on up to 81% on the no change. I'm thinking this may be the same situation that happened the last time Powell gave a quarter point, because remember, he was very hawkish going into the December rate cut. Many people thought we would not get a December rate cut. If we, in fact, are seeing jobs curb slightly, then maybe that slows it down. But he mentioned one thing that was a critical point, and that was that they think the job numbers are inaccurate, so they're waiting for more data. If the jobs, which I believe are going to come back, more pressure on the Fed, we will see a little bit of a different January going ahead. So I'm still neutral, I guess, in general, but there's some clear indicators that the Fed is setting up for something. And I don't know if this is something is broke, if they're having to deal with these kind of situations. They're looking at maybe what's happening in Japan, how this plays into the Treasury side of things. But there is something brewing in D.C. And of course, this also could be pressure just from what we will see coming in from the Trump administration, what this new Fed chair is going to look like, who is it going to be? All of that plays into it. Listen, if you're not subscribed, guys, this is going to get exciting, I think, and as we go into the next market. I want you to subscribe to the channel right now because you'll catch these live streams and many more just by clicking that little bell. It'll notify you all that. And if you're not in this thing right here, the Bear Market Edge, this is our own private group. And what I do in there is we drop multiple analysis each week. Never makes it here to the show. We don't really go into all that. But the research is built on, and we put it out in the Bear Market Edge so you guys can join for free, get more insights over there. And of course, follow me on X, @PaulBaron. I leave my DMs open for you guys. If you had questions, drop them in there. We'll catch you next time right here on The Paul Barron Show.